I thought the best way to address the outlook, to quote Warren Buffett, is now the time to be greedy in our pursuit of achieving the highest risk-adjusted returns for our clients. We believe so, but how can we be so certain? Shoshana Zuboff, author of The Surveillance Capitalism and Harvard professor, made the following remarks about the dominance of the social media platforms. Social media platforms do one thing: they sell certainty to advertising companies on the success of their ads. Therefore, you have to make bold predictions regarding the potential success of the ad. To make bold predictions, it starts with one imperative: you need a lot of data. At Gryphon Capital, we too have a lot of data. So, what is it telling or informing us? The COVID-impacted borrower has been reflated by the sheer quantum of fiscal stimulus from the governments. Compared to the crisis in 2008, the stimulus was at 4% of GDP. Now, as we've hit the pandemic, we are now standing at 11% of GDP of stimulus. Also, household savings has risen from 6% to 19.8%. We've seen this evidence of this through our mortgage lends, whereby borrowers are paying down their debt at such a rate you could be mistaken that Australia is going through a property boom. Who would figure? We often quoted in the press by saying RMBS bonds thrive in a low mortgage rate environment. Why? Because it increases affordability through it lowers your mortgage repayments. This has shown up in the percentage of borrowers that are behind on their mortgage repayments by more than 90 days. Interesting, this percentage has been very, very stable, hovering around 0.35%, which is the same level as it was about a year ago. Now enter the new game in town, or the new RBA regime, i.e. use it or lose it. What does it mean? Use it, the banking system has been flooded with cheap money, and lots of it. And lose it, the RBA will pay 0% on excess funds placed back at the RBA by those banks. So it appears it's all about the extension of credit. Who benefits, who loses? History tells us that prime borrowers will benefit in uncertain times because of their predictable behaviour when it comes to making mortgage repayments. Whereas the weaker borrower is likely to miss out on a better deal due to their repayment habits, which at times can be deemed unpredictable. It also helps having a more normalised approach to responsible lending, making it easier, and what we mean by that, quicker turnaround times for credit to get into the hands of the Australian consumer. Reiterating the theme, it is all about reflating the consumer and to restore consumer confidence with the goal of getting the country moving again. On housing, we remain hesitant to forecast due to the lack of recent data points that we've seen. But our bias is leaning towards a constructive outlook on the housing market here in Australia. Anecdotally, we can point to evidence emerging in the UK whereby the average national house offer price has increased month on month. This, coupled with a whatever it takes attitude by the government, has our investment committee coming around to the view that the Australian housing market is at or close to its peak to trough cycle bottom, and that's important. Lastly, we couldn't finish this topic without a reference to what is happening to all those COVID impacted borrowers who have elected hardship or a modified payment arrangement. In our previous market update back in the eye of the pandemic storm, May of this year, we referenced the level of COVID borrowers in our GCI portfolio by applying a multiple of cushion over the level of the COVID borrowers. We expressed the cushion as a multiple to illustrate the robustness of the portfolio in times of extreme stress. At the time, the multiple was approximately 3 to 4 times before our analysis revealed the performance of the GCI holdings could become uncertain. Good news, fast forward to today, approximately 60% of those impacted COVID borrowers have cured, And what we mean by that, back in line with their scheduled repayments, implying the multiple of cushion has ratcheted higher to 7 to 10 times over this window of uncertainty. Hence, all the data paints a picture, reinforcing our belief that there is no better place to invest when you are seeking sustainable, predictable income, driven off bonds that are engineered to bend, but very hard to break. And therefore, we hope now, like the team at GCI, you too are of the opinion, with certainty, Australian RMBS bonds are truly loss remote.